warm welcome to you traders. Okay, so let's have a look at the risks involved with options. You may be thinking about trading options. You may think, hey, you know what, I get a lot of kind of bang for my buck, so to speak. Capital goes down, I can get many multiples of it, hundreds, thousands of percent. All looks very good. But as always, guys, in trading, there's no free lunch. So let's look at the risks involved with options so we can decide whether it's a product that we want to investigate further. Okay. First one is potential losses. So we have got a high chance of a worthless expiry. You know, unlike if we're buying an underlying stock or an asset, futures contract, whatever it is, let's say we bought, Apple, the chance of that going bust are pretty slim. So we buy, $1,500 worth of stock in Apple. Unless it goes bust, we're not going to lose that $1,500. However, if we buy some contracts that now come out of it or have a worthless expiry, which is quite a high probability because we're very specific with our strike price, our expiry date, etc., you will lose that total amount. So, you've got to be careful about the potential losses. It's not the same as buying underlying. You've got to consider it as a trade as opposed to an investment, or if you're doing a longer term. So you've got to consider the losses that you're buying with the contract. They're a different product and there are potential high losses, which brings me to selling options. Selling options can seem like free money, right? You're just selling insurance, taking the premiums. If you go so far out, you think, well, it's never going to go there. Unfortunately, they're priced accordingly. And every now and then, something's going to hit the market or hit that stock. It's going to be going to the stratosphere. If you're selling a call option, all of a sudden you have got a many multiple of your reward risk on the table. Let's say you're collecting $1 worth of premium if they expire worthless, which they do most of the time, and then all of a sudden this thing shoots up and you've suddenly got to pay $20. You've got a massive risk and you can lose a lot of money. So being very mindful of the total risk involved with buying or selling call or put options. All right, number two, complex. It's not as simple as understanding long or short, right? We know if we go long, go short, multiply that by a position size, it's easy to work out. Options are much more complex. Even based on a call or put option, sometimes the value of them adjusts depending on the implied volatility. And we're looking at, say, well, the strike hasn't moved. Time to expiry has not done much. There's so many different variables that go into the pricing. Sometimes it's very difficult to predict or understand how our P&L is affected. And that's just from a basic call or a put option, buying or selling that. When we start doing different spreads and different structures of those, then it really becomes challenging and can become quite complex to understand our total risk, our total reward, when we get paid out, when we don't, when we want to take profits, when we want to let them run. So it's a little bit more of a challenging game to get our head around. All right, number three, liquidity. The asset, underlying asset or the stock and or the strike price that we're looking for may be illiquid, because when we go and trade look, some of the higher liquidity stocks out there like Apple, Tesla, Netflix, IBM are going to be reasonably thick. But even those, if you're going to some really unusual future expiry date and unusual strike price, liquidity in those options is still going to be thin. So when you start going down to the second tier shares and thinner shares and stocks anyway, when you start trading those options, the liquidity might not be there. So that means you might not be able to get in or out when you want to. So you might not be able to trade, you might have to hold to expiry, and which means you might not be able to cap the risk, you might have to use the strategy you want, all sorts of problems potentially with something you're trading with illiquidity. It's something you're buying a share, right? If it's illiquid, hey, I've got to be careful, I can't get out. When I want to get out, can't scale in or out, I need to understand the consequences of that illiquidity. Okay, number four, spreads are often large. So similar to being the illiquid, that may mean you can't get out at all, but if the spreads are large, sometimes the price of the option might be $1, but the bid and the ask might be 1 to 125, which is a huge spread. Yeah, sure, those things can move massively. So spread as a percentage of potential return isn't that much, but you've still got to consider that is a cost of doing business. If you sell that immediately, you've lost a significant amount. If you were to buy a stock with that, same kind of thing. So the spreads are often large, and when things are moving as well, or with uncertainty, the spreads are large. If liquidity is low, then of course spreads are even going to be larger. And commissions can be relatively high, especially if we're trading some kind of spread, some kind of structure, trying to structure some kind of trade with a combination of options. We might have 4 different legs to trade, which will result in four times the spread, 4 times the commission, and of course in and out, maybe we're doing that. So we've got to understand that there are more costs generally associated with trading options, or potentially more costs with trading options. Final thing, guys, is our time decay. So time decay can negatively impact our option price. If we're buying something, as we get closer to expiry, the value of that option is going to decline, even if the stock price stays exactly where it is. Okay, as the time to expiry starts to go, if nothing else changes, that's going to reduce the value of our option. So we've got to be right quick. We want to be right quickly, and that can negatively impact the price. Obviously, if we're selling, it's going to positively impact, but if we're buying an option, it can negatively impact. So the point is, we need to understand how time decay influences the price, or have a reasonable assessment of how that's going to influence the price of the option that we're buying or we're selling. So again, adds to a little bit of complexity. It's not just as simple as whether the stock's going to go up or it's going to go down. It's how quick it's going to go up or how it's going to go down. How it's going to do it. Is it going to have extreme volatility? Is it going to spike up there? Some news might be related to it. There's all kind of different things. So you've got to understand the risk involved with options, guys. As with any financial product out there, they're risky. The potential rewards are huge if you get the options right, but then of course the risks are also huge as well. You're going to be losing money time after time after time after time just to get that big hit. So understanding your potential losses, the complexity and understanding the kind of thing you're trading, how different things are priced and how it affects it. Liquidity, making sure you've got the liquidity that you need to get in or out of the trade that you're trying to express. The costs, the spreads, how much the spreads are going to cost you, how much the commission is going to cost you, whether you're doing a multiple mix of stuff, and of course the time decay, guessing how that is going to affect the price of your option. If the stock just stays where it is, 1 month later you can sell it, you get your money back, break even. An options contract, if you buy a put or buying a call, price is exactly where it is, 1 month later you're going to have lost money. So understanding how that will affect your overall thesis on the trade. Anyway guys, risks involved with options. Take care. See you in the next one. Bye bye.